Hi, this is Matt Glubna, financial planner with Waypoint Partners, and this is your Waypoint Virtual Minute. When you invest in a mutual fund, you're buying into a large pool of investments, stocks, bonds, or a mix of both. Throughout the year, the fund's managers are constantly making decisions inside this portfolio. They might sell a stock that's grown a lot or trim a position that no longer fits their strategy. And when they sell something for more than they paid, the fund realizes a capital gain. Here's the part that surprises a lot of investors. Even if you didn't sell anything, the fund may still pass those gains on to you. These are called capital gain distributions. Mutual funds are required to distribute most of these gains they realize each year, and those distributions typically happen toward the end of the year. There are two types of gains the funds might distribute. Short-term capital gains come from investments the fund held for 1 year or less, and those are taxed just like ordinary income. Long-term capital gains from investments they hold for more than a year, and those usually qualify for lower tax rates. Either way, the fund reports them to you on a 1099. Now let's walk through a simple example so you can see how this plays out. Imagine you own 1,000 shares of ABC Growth Mutual Fund that you bought for $50 a share in a taxable investment account for a total of $50,000. Over the course of the year, the fund managers sell several stocks inside the portfolio for a profit. By December, the fund has realized a $2 per share in long-term capital gains. Because mutual funds must pass most of those gains to shareholders, the fund issues a $2 capital gain distribution. Here's what this means for you. You receive a $2 distribution for each 1,000 shares for a total of $2,000. If you elect to reinvest those distributions, that $2,000 automatically buy more shares of the fund. But even though you didn't sell anything, the money was reinvested. The IRS still treats the $2,000 as taxable income for the year. To recognize that you have now paid capital gains in this distribution, the amount of distributed gain increases your cost basis. So in this case, the 2,000 gain is added to your original $50,000 basis to make it a $52,000 going forward. That's why capital gains distribution can catch people off guard. You can owe taxes on gains triggered by the fund's internal trading, even when you personally didn't sell a single share. It's simply part of how mutual funds are structured. The key takeaway from this, mutual funds are efficient investment vehicles, but in the taxable accounts, their internal activity can create tax consequences for you. Understanding how capital gains distributions work helps you avoid surprises and plan more effectively for the long term.